Why do most retail traders keep losing money? It's not because the market is too random, it's because they don't understand how it really works. Today, I'm taking you into the world of smart money concept, a trading methodology used by institutions, banks, and market makers. You'll learn the three most important pillars: BOS, CHOCH, and order block. By the end of this masterclass, you'll be able to read the institutional footprints left behind on the charts. You'll know exactly where the big money enters and exits, and how to use that intel to make smarter trading decisions. I'm Gems, and welcome to this complete smart money concept masterclass. Part 1. What is smart money concept? Before we dive deep, let's get one thing straight. What exactly is smart money? Smart money refers to the capital controlled by large institutional players, banks, hedge funds, market makers, and central banks. These players have massive funds, deep analytical capabilities, and the sheer size to actually move price. Now, smart money concept, SMC, is a modern price action trading methodology built on one core idea. The market is dominated by this smart money. If we can read the footprints they leave on the chart, we can trade with them instead of becoming their prey. This isn't an indicator, it isn't a mechanical system. This is a complete philosophy for analyzing the market. Key takeaways. SMC analyzes the behavior of large capital. Core focuses: market structure, order flow, and liquidity. The ultimate goal is to align your trades with institutional flow, not against it. Here's a classic example. Price breaks below an obvious support level, triggering retail traders' stop losses. Retail traders think the breakout is valid and start shorting. But suddenly, price reverses violently to the upside. That's an institution sweeping liquidity. SMC teaches us to spot these traps in advance and turn them into high-probability entries, not losses. Part 2. Market Structure Basics. Before we get into BOS and CHOCH, we need to nail down market structure. Price moves in only three states. 1. Uptrend, higher highs and higher lows. 2. Downtrend, lower highs and lower lows. 3. Consolidation, range. Price oscillates within a range. Institutions are accumulating here. Remember this. Institutions respect market structure because structure reflects who is in control. When structure shifts, control is shifting. Pro tip: pick one time frame to define your structure. For most traders, the 1-hour chart offers an excellent balance, enough to filter noise, yet clear enough to show the true trend. Part 3. BOS, break of structure. Alright, let's dive into the first core concept, BOS, break of structure. A BOS occurs when price breaks above a previous swing high or below a previous swing low. It signals trend continuation. Bullish BOS occurs in an uptrend. Price breaks above the previous higher high, PHH, confirms the uptrend will continue. Bearish BOS occurs in a downtrend. Price breaks below the previous lower low, PLL, confirms the downtrend will continue. Put simply, BOS equals the trend is still alive. Technically, BOS shows that momentum is still in the direction of the trend. Psychologically, it tells us the dominant side is still in control. Critical rule: many traders use the wick, high or low, to identify a BOS. However, a more reliable method is to use the body close, candle close, for confirmation. This filters out a lot of false breakouts. Practical takeaways: consecutive BOSs equals healthy, strong trend. Trading in the direction of the BOS yields higher win rates. BOS is a confirmation signal, not an entry signal. It tells you the trend is intact, not get in right now. Part 4. CHOCH, change of character. Next up, our second core concept, CHOCH, change of character. If BOS tells you the trend is continuing, then CHOCH is telling you, hold up, the trend might be losing steam. Bearish CHOCH occurs in an uptrend. Price breaks below the previous higher low, PHL. Warning, the uptrend may be reversing. Bullish CHOCH occurs in a downtrend. Price breaks above the previous lower high, PLH. Warning, the downtrend may be reversing. Simply put, CHOCH is the very first warning signal that a trend reversal may be underway. Key difference between BOS and CHOCH. BOS, CHOCH. Direction. In the direction of the current trend. Against the current trend, meaning trend continuation. Potential trend reversal. Nature. Confirmation signal. Warning signal. Critical. A CHOCH by itself is not an entry signal. It's just telling you to pay close attention. After spotting a CHOCH, you should look for confirmation. For example, waiting for price to retrace to an order block or an FVG. Practical tips. CHOCH carries more weight when it occurs near key levels, support/resistance, order blocks. One CHOCH doesn't mean the trend has reversed, it's the first yellow flag. Multiple bosses in a row equals strong trend. A CHOCH appears equals shift to caution mode. Part 5. Order block. Alright, we've got BOS for continuation and CHOCH for warnings. Now for the third pillar, order block. Order blocks are arguably the most powerful concept in SMC. It represents the area where large capital built substantial positions just before a strong directional move. Bullish order block. Forms before a strong upward displacement, impulsive rally. It's the last bearish candle before the rally. Represents where institutions placed large buy orders. Price is likely to return to this zone for institutions to add to positions or fill remaining orders. Bearish order block. Forms before a strong downward displacement, impulsive drop. It's the last bullish candle before the drop. Represents where institutions placed large sell orders. Price is likely to return to this zone for institutions to continue executing orders. Simply put, order blocks are the footprints left behind by institutions. How to identify a valid order block? Find the impulsive move. One or several aggressive large candles. Find the last opposite candle before that impulse. That's your order block. Mark the high to low range of that candle. That's your order block zone. Order blocks act as institutional support or resistance for future price action. Price frequently returns to these zones because institutions need to scale in or finish filling pending orders. Practical application. When price enters the order block zone, look for BOS or CHOCH confirmations to time your entry. Order block zones offer high probability trade opportunities. Combine with other SMC concepts like FVG, fair value gap, to increase your edge. Part 6. How the three work together. Now let's tie it all together. BOS, CHOCH, and order blocks aren't meant to be used in isolation. They form a complete trading system. The complete SMC trade flow. Step 1. Determine the overall bias, higher time frame. Use the 1-hour or 4-hour chart to establish the dominant trend direction. Step 2. Wait for structural signals. If trend continues, watch for a BOS confirmation. If trend might shift, watch for a CHOCH warning. Step 3. Locate the order block. At the point of structural break, find the last opposing candle before the impulse. That's your OB. Step 4. Wait for a retracement. After the breakout, wait for price to pull back into the order block zone. Step 5. Confirm and enter. Watch for price reactions inside the OB, rejection wicks, reversal patterns. Enter after a confirming BOS or CHOCH in your entry time frame. Example, going long. You confirm an uptrend on the 1-hour chart. Price breaks a previous high. Then bullish BOS confirms the trend continuation. Before that breakout, you find the last bearish candle, then bullish order block. Price rallies, then pulls back into that OB zone. Inside the OB, you spot a rejection candle signaling selling pressure is exhausted. Enter long. Stop loss just below the OB. Take profit at the previous high. This is the power of SMC. It removes guesswork and replaces it with a logical, rule-based framework. Part 7. Common mistakes and warnings. Before we wrap up, I want to highlight some common mistakes I see traders make. Mistake 1. Using CHOCH as an entry signal. CHOCH is a warning, not a confirmation. Jumping into a counter-trend trade just because you see a CHOCH is a recipe for losses. Mistake 2. Using wicks to confirm BOS. Using candle wicks to determine structural breaks opens you up to false breaks. Using the body close is far more reliable. Mistake 3. Trading trends in ranges. If price is stuck in a consolidation range and you don't see a valid BOS, body close breakout, do not force a trend-based strategy. Mistake 4. Ignoring time frame alignment. Mixing structural analysis from different time frames leads to chaos. Pick one time frame to define your structure and use a lower time frame only for refining entries. Mistake 5. Treating order blocks as exact lines. An order block is a zone, not a single price line. Always place your stop loss outside the zone to give price enough breathing room. Let's quickly recap what we covered today. BOS, break of structure. The confirmation that the trend is continuing. CHOCH, change of character. The first warning that a reversal might be coming. Order block, the institutional footprint, a high probability zone where large orders are placed. These three concepts are the absolute foundation of SMC. Master them, and you'll start reading the market's institutional language. But remember, knowing isn't the same as doing. Watching this video isn't enough. You need to get on the charts, practice identifying these structures, and test your strategy through backtesting. If you found this masterclass helpful, please like, subscribe, and share it with anyone who needs it. Drop a comment below and tell me, which SMC concept do you want me to dive deeper into next? I'm Gems. See you in the next one. Trade smart and manage your risk.